So you're thinking about making a move to the greater Boise, Idaho area, but you have no idea what's happening right here in our real estate markets. Well, I'm glad you're here. Welcome to Mikey's Monthly Market Updates for November of 2024. My name is Mike Petras with MPRE Residential, powered by Next Home Treasure Valley, and in this video, we'll bring you the latest insights and real estate trends happening right here in the Treasure Valley. If you're looking to stay ahead of the curve in the ever-evolving market, or you are looking for information to make informed decisions on buying, selling, or investing, you've come to the right place. So make sure to hit that subscribe button below, hit the notification bell so that you're constantly in tune with the videos that I do come up with, and let's get started. But before we do, if you'd like to begin your home search in more real time than websites like Zillow, Realtor.com, and Trulia, please visit www.mpre.homes and sign up for your personalized home search today. And no worries, I won't spam you. And if you're looking to sell and want an idea of what your home is worth in today's market, also visit my website, click on the Home Evaluation tab in the upper right-hand corner, and obtain it. You most likely will hear from me, but again, I pride myself on being a non-pressure real estate agent. If at all, I would simply like to introduce myself in the phone call and let you know I can be of service when you're ready. So let's get started with the information and start off with Ada County like we normally do. And as we can see by this slide, the median home sold price on a county rose this month. Unpredicted according to the inventory trends we have been seeing recently, however, are things beginning to change with inventory, or is this a one-off fluke? Stick around. As we can see by this graph, we are sitting at a median home sold price of $544,900. In comparison, this is down 0.89% from January of 2022, down 9.52% since the peak home value of $602,250 in late May, early June of 2022, the beginning of the market correction, and has made gains of 9.52% since the end of the market correction in January of 2023, where we're sitting at $487, $495, and this year in Ada County, it is currently up 5.49% since the $514,975 we can see in green. Overall, and since the end of the market correction in January of 2023, the real estate markets in Ada County have been chipping away at the losses incurred during the market correction. Since last month, the median home sold price gained 1.83%. Again, is this a one-off fluke, or is the inventory levels starting to do this as we swing into the holiday seasons beginning to show us something? Let's cover this. Looking at the inventory versus buyer's demand, there it appears to be. Inventory is beginning to make the seasonal turn, sitting at 1,722 homes available for sale, with 755 selling in the month of October. But what about the buyer's demand? As we can see by this graph, we're beginning to see a decline. However, what about the mortgage applications in the United States? We all know that rates not so long ago began to plummet. Now they are back up. And why? Because the markets have shifted their focus to the health of the labor markets. As we can see by this graph, mortgage applications rapidly came down. But look at that brief spike that we had, and again, not so long ago. Can we expect rates to come down in the near future? Stick around to the end of this video to find out. In summary, however, currently inventory is beginning to slip, and as long as it continues to do so, and eventually catches up to the pending line in orange, prices and any leverage buyers have versus the seller will negate itself. So please keep this in mind. So if the inventory is beginning to decline, which category is subtracting most of the overall total single-family homes? Breaking it down, we can see that existing homes have 941 homes available for sale, with 514 selling in the month of October, placing us at 1.83 months worth of inventory. This is dramatically down from the 2.2 months of worth of inventory that we had the previous month. This, in my humble opinion, is attributed to the decline in mortgage interest rates that we saw not so long ago. But as we can see by the pending line in orange, now the rates are back up. Expect buyers' demand to continue to be on the decline. But again, as long as inventory line catches up to the pending line, we can anticipate buyers to lose their edge against the sellers as prices stabilize. But what about new construction? Inventory is still on the rise. Whoops! Have the builders realized they've overbuilt? I would say this is a reality. But why is the buyer's demand gaining steam, indicated by the pending line in orange? It is because mortgage interest rates did come down briefly, but the biggest reason is that the builders are still offering incentives. Stick around to the end of this video to see how this benefits you as a buyer. So what about the median home sold price for both existing and new construction? Although the inventory signs are showing that prices should be coming down, one of the two categories may surprise you. Looking at this month in existing homes, we can see that the median home sold price slipped to $530,000. This is down 1.30% since last month. But overall, existing homes have been sort of bucking the odds. Since the end of the market correction in January of 2023, existing home median home sold price has gained 10.37%, and since January of 2022 has gained 2.81%. However, since the beginning of the market correction back in late May, early June of 2022, it is still down 9.67%. But what about new construction? In a shocking turn of events, new construction has made a significant rise, up a whopping 7.92% since last month. However, is this a one-off fluke? Compared to last month, it is. More higher prices homes sold than lower. This allowed the jump in the median home sold price. Considering the inventory and buyers' demand available in Ada County, what should we expect overall? That's right, prices to continue to come down in new construction. So don't fret yet. However, if interest rates were to come down again, this can very well change and quickly. New construction, though, is still down from the 588,945 in January of 2022, 3.48% down to be specific, down 17.62% since the top of the market correction in orange, but overall is chipping away from the market correction low of 494,900 at a rate of 12.93% in gains since that mark. And what about since the beginning of this year? It's up 6.75%. However, I wouldn't hold your breath on this trend lasting in new construction. How about the health of the real estate markets in Ada County? Well, that is determined by two things, the days on market and the cancels and expireds. Looking at the days on market, we had an unexpected decline, given that we are leading into slow season historically, hitting 39 days on market. So are the markets beginning to heat up in quarter four? I'd honestly say no, but why? Well, because of the mortgage interest rates. They are back on the way up because the market shifted their focus to unemployment numbers. I believe this decline was a result of mortgage interest rates coming down for however briefly they did. Buyers returned to the market and quickly to take advantage of better rates, something that I did anticipate. So given this, I wouldn't expect the days on market next month to lower. The key to watch out for here in the levels of days on market, for example, would be when the days on market hit high levels like we saw in January of 2023. This means that the seller's market is struggling. When that happens, we can anticipate prices to come barreling down, which they did. When they crash down to low days on market, we can anticipate the opposite, sellers having a massive advantage over buyers, which they also did. But looking at today's trends and back to 2019, we can see that we're basically out of balance. So have the markets returned to normal in Ada County? Well, that depends on mortgage interest rates, but stick around to the end of this video where we'll go ahead and address just that. What about cancels and expireds? For the fourth straight month in a row, cancels have been on the rise. While expireds are generally those holdout sellers that want their price and refuse a price reduction until the end of their contract, cancels, however, are generally more of the trend that we should be looking at. A rise in the cancels can mean a few things. It can mean that sellers are getting cold feet and pulling their homes off the market. It can mean that buyers couldn't get the interest rate that they were looking for and fell out of contract, which led to a subsequent cancellation. Or in this case, it's probably because of seasonal swings still. Sellers know, just like real estate agents, that the markets cool down during quarter four. The holidays are also right around the corner and the kids have went back to school. So what can we expect? This number to rise. Overall, however, by the days on market and the cancels and expireds, the overall health of the real estate markets in Ada County is looking okay. Nothing again seems to be super alarming by the data. All right, Canyon County, it is your turn. And as we can see by this slide, the median home sold price on a county level has dipped from last month. If you are subscribed to this channel and follow Mikey's monthly market updates, this seems to be the norm for Canyon County, up and down. We're sitting at a median home sold price of $415,699. In comparison, this is back down 2.16% since January of 2022, down 12.75% since the peak home value of $476,500 in late May, early June of 2022, but has main gains, up now 4.87% since the end of the market correction in January of 2023, where we're sitting at $395,445. And since this year, with all the ups and downs, we are still up 3.77% overall, which can be considered typical growth for Canyon County in a normal market setting. So overall, the real estate markets in Canyon County have also been chipping away at the losses incurred during the market correction. Since last month, however, the median home sold price is down 1.93% to be exact, but as we can see over the course of the year, it has been up and down. This will continue to be the trend to monitor. Again, why is this though? It's because of supply and demand, the key factor in how real estate, much like everything else, is valued. Looking at inventory versus buyer's demand, inventory has flattened out. Will it continue to come down overall? I'm anticipating it to do so. Currently, Canyon County is sitting at 1,127 homes available for sale, with only 422 selling in the month of October, placing Canyon County at 2.67 months worth of inventory. But what about the buyer's demand? As we can see by the pending line in orange, the buyer's demand is diving. But why is that? For more information on this and the best strategies on how to succeed in buying, selling, or investing right here in the Treasure Valley, stick around to the end of this video where we'll go ahead and discuss just that. So if the inventory is on the rise, which category is adding to the most overall total single-family homes? Breaking it down, we can see that inventory in existing homes is slightly down from last month and is almost flatlined, with 562 homes available currently for sale and only 225 selling in the month of October, placing us at 2.49 months worth of inventory, along with the buyer's demand continuing its decline. While existing homes show some items to monitor, as in the inventory flatline trend, new construction is getting interesting. Looking at new construction, inventory seems to be showing a stop trend. For the second straight month in a row, inventory has flatlined. Have the builders realized they've overbuilt? Currently, there are 565 homes available for sale, with 197 selling in the month of October. But as we can see, the buyer's demand is still slipping. In fact, it almost seems to be falling off a cliff. Overall, new construction has been adding, in my opinion, to the most overall inventory for the total single-family homes. This is good news if you're a buyer looking for new construction in Canyon County. This also is most likely why we have been seeing the up and down bounce in the median home sold price. While inventory is staying at high levels and the buyer's demand is falling off a cliff in both existing and new construction, should result in price declines. So stay tuned by hitting that subscribe button below, hit the notification bell so that you're constantly in tune with all of this information. We will also be solidifying the best strategies for buyers later in this video, so stick around. But back to the data, is the proof in the pudding with price reductions because of the gap between supply and demand? Yes, it is. By this graph, we can see that the median home sold price dropped for the fourth straight month in a row to $380,000 for existing homes. This is down 2.56% since last month. And since the beginning of the market correction back in late May, early June of 2022, existing homes are still down decently, 10.58% to be exact. But since the end of the market correction in January of 2023, existing home median home sold price has gained 10.78%. Existing homes in Canyon overall have been making significant gains. How about since the beginning of the year? Down 1.29%. Since January of 2022, the existing home market is back down in the downwards direction by 2.56%. But what about new construction? New construction dipped back down again this month. The fluke in the price gain, as mentioned in last month's Mikey's Monthly Market Update, has corrected. Something I predicted. Since last month's $452,490, the median home sold price significantly dropped to $431,686. That's a drop of 4.59%. However, new construction is still down from the $465 in January of 2022, 7.16% to be specific, and is even further down since the market correction in orange by 21.36%. How about when the market correction stopped in April of 2023? Gains for sure, but significant? But they are up 5.98% since that mark. But since the beginning of January of 2024, in green, at the $404,990, new construction has gained 6.18%. Not bad for a year's worth of time at all. So if you're looking for the best value, is it new construction or existing homes in Canyon County? Stick around to the end of the video where we'll go ahead and discuss just that. How about the health of the real estate markets in Canyon County? Well, again, that's really determined by two things: the days on market and the cancels and expireds. Looking at the days on market, according to the data, we can see that we hit 47 days on market for the average sale. Again, what are we looking for in these trends when it comes to days on market? Well, when they hit high levels like we saw in January of 2023, this means that the seller's market is struggling. When this happens, we can anticipate prices to come barreling down, which they did. When they crash down to low days on market, we can anticipate the opposite: sellers having massive advantage over the buyers, which they also did. But looking at today's trends and back to 2019, we can see that we're basically at a balance. So, have our markets returned to normal in Canyon County? How about the cancels and expireds? This month, the cancels and expireds appear to be on the rise. While the expireds are generally those holdout sellers that want their price and refuse a price reduction until the end of their contract, cancels, however, are generally more of the trend that we should be looking at. A rise in cancels can mean a few things. It can mean that sellers are getting cold feet and pulling their homes off the market. It can mean that buyers couldn't get the interest rate they were looking for and fell out of contract, which led to a subsequent seller cancellation, which actually happened this month because of mortgage interest rates went back on the rise. But in this case, it's most likely still because of a majority of seasonal swings. Sellers know, just like real estate agents, that the markets cool down during Q4. Holidays are also right around the corner and the kids have gone back to school. So what can we expect? This number to rise. Overall, however, by the days on market and the cancels and expireds, the overall health of the real estate market in Canyon County, again, is looking okay. So you've made it this far in the video. Awesome. Of course, if you have any further questions, please feel free to reach out to me. I'm happy to answer. And again, I'm a no-pressure real estate agent, so your phone call will not lead to spam calls and emails. However, if you like what you see so far and would like to stay in tune with the Treasure Valley real estate markets or greater Boise, Idaho area, please hit the subscribe button below, hit the notification bell so that you're constantly in tune with this information, and welcome to my channel. Also, if you're looking for a more in-depth overview about the cities in the Treasure Valley and what they have to offer, please click on the link below and download my free relocation guide. This is a great source to get to know the Treasure Valley before you decide to make the move. So now let's move on to the best strategies if you're looking to buy, sell, or invest, or if you're even renting, right here in the Treasure Valley. What is the data showing us, and is this a good time to make any moves? No pun intended. Buyers, let's get started with you. The biggest thing you have to deal with this month going forward is going to be the mortgage interest rates. And while the Fed may have made another 25 basis cut to the federal funds rate, the mortgage interest rates did not flex much in the downward direction this time, or at least they haven't yet. Well, Mike, I thought the federal funds rate controls mortgage interest rates. It does not. The federal funds rate controls short-term loans such as credit cards and auto loans, but it does have a ripple effect to them. Well then, Mike, why did mortgage interest rates come barreling down when the Fed made their first rate cut? Well, that is because the markets were looking for direction from the Fed, since the Fed has one basic job: to keep inflation at bay while not affecting the job market. A lot simpler than you thought, huh? Well, it really isn't. The last time a soft landing occurred was in the 90s, and it's rare. Usually the balancing act the Fed plays results in a recession. When the first rate cuts were made, the market's thinking was on edge, but it welcomed that the Fed finally made a cut, which resulted in lower mortgage interest rates being baked in. However, it also made the markets paranoid. If the Fed cut by 25 basis points, that meant there was still a problem with inflation. If they cut by 50 basis points during the first one, that means that the Fed was more worried about unemployment. Well, the Fed cut by 50, which turned the market's focus to unemployment, and thus has resulted in the higher mortgage interest rates, because employment has been bucking the odds. In fact, they've been coming in quite robust lately. The numbers, that is. Not softening according to the Fed's monetary policies in place. See, what the markets really kind of want to see is a softening of the employment numbers in relation to the Fed's monetary policy. Until the markets can get comfortable with employment staying in a balance with the Fed's monetary policy, they will react and be paranoid. And they are. Let's just put it this way, they don't believe the unemployment numbers just yet. In fact, neither do I. Please see this short video in the upper right-hand corner to see why. The Bureau of Labor Statistics, in my opinion, has been fudging the numbers that the Fed sees. The key is, though, if you are a buyer, is to pay attention to the unemployment numbers, period. And you can view them on marketwatch.com under the economic calendar. A couple of other things to watch is the Psalms rule, which successfully predicted recessions, which has currently went back under the threshold, and the reinversion of the yield curve, which usually always brings on a recession, which is currently happening. So in part, the markets have their eyes laser focused on a possible recession. However, the numbers currently show that the Fed could bring this in for a soft landing. But as a buyer, what to know is the markets just flat out don't feel comfortable yet with the Fed's monetary policies and where they are. Did they hold on to the federal funds rate too long, which can affect unemployment in the U.S.? That is what they want more proof of. And until they feel comfortable, expect mortgage interest rates to stay high and defensive. But in the event the National Bureau of Economic Research officially declares a recession, the Fed will drop the federal funds rate quickly, and that will lower mortgage interest rates. But you also have to consider your job and how stable it is. I know, confusing, right? Well, if you want to stay in tune with this information, please click on the subscribe button below. I'll be happy to guide you along. That's what I'm here for. Well, Mike, what about the election? We just got Donald Trump back and a majority of the Senate. Well, if Republicans can maintain majority in the House too, we could see things change and fast in the economy, which can also help the economic outlook. Like American Independent Energy, this will help the Fed out immensely and the American people. So we are in a pattern of wait and see, but don't count the Fed out of coming in for a soft landing. They could. That is really what you need to know. And by mid of next year, we could see rates land comfortably in the mid to low fives. If you are waiting for mortgage interest rates to return to the 3 or 4s again, don't count on that anytime soon. Overall, though, the key, again, to home value is supply and demand. And as we saw by the data, supply is on the rise in both existing and new construction, while the buyer's demand is on the decline overall. Are the inventory brakes being put on like we saw last month? Well, not really according to this month's data, but they could be, especially as we lead into slow season, which is historically Q4 to Q1. Mortgage applications on a national scale also took a big hit, dropping dramatically. This is as mortgage interest rates came roaring back to higher levels. So this very well could create a continued gap between supply and demand, which could result in the continued lowering of home prices. Higher inventory levels, though, could result in advantages for you buyers, as sellers get more desperate to sell their homes. As more inventory lingers and buyers' demand declines, buyers with an experienced agent such as myself can hustle a better deal from the seller. I can also negotiate for top level of concessions, which can be used to buy down your mortgage interest rate, closing costs, professional representation, etc. In fact, some builders in the Treasure Valley are still offering concessions. So while mortgage interest rates are not ideal at the moment, deals can be made as sellers struggle with additional competition in the markets and a diminishing buyer base. In fact, historically, the holiday times are great to find good deals. Concessions offered by the seller can also get you a rate in the 5s and permanently for 30 or 15 years. Should rates come tumbling down next year, you could always refinance too. And while you may be saying now, time to rush off to the builder or existing homeowner and get a great deal, pump the brakes. Remember that working with the builder or seller directly has a huge disadvantage, and that is, who does a builder's agent work for and who does a listing agent work for when it comes to existing homes? That's right, they represent the builder or the seller. And while they might entice you to work directly with them, an experienced agent like myself represents you and your best interests versus the seller. So whether it be me, my team, or another agent you find on YouTube, always hire an independent agent to represent you and your best interests versus the builder seller. Do not fill out anything with a builder until you have considered independent professional representation thoroughly. You could place your real estate agent in a rough spot otherwise. Furthermore, speaking of builders, and since the market correction, they've taken the biggest overall hits in the median home sold price. So again, with or without concessions, a new home is generally your better deal. Plus, you're getting a new home that has an edge in itself. But again, don't discount existing homes. The same trends exist. A significant gap between supply and demand, and home prices have been continuing to come down due to such. Given this, smart sellers, in order to compete with the builders, for example, and other sellers, should be offering concessions, or at least have thoughts to them, should they come up in a buyer's offer. The reality is, though, that not a lot of sellers are offering concessions like the builders would, or can, or will be transparent about them. Even some sellers, due to the NAR settlements, are also refusing to contribute a co-op commission offering to the buyer's broker. This could mean that you, the buyer, would be on the hook for the cost of professional representation for your agent. This also depends on the negotiations you made with your agent at the buyer's representation agreement meeting. Some builders, on the other hand, have already made it known to local agents that they will offer a buyer's co-op commission for professional representation. So it can be a gamble in the existing home market as compared to the builders, who seem to have pre-circumvented the new DOJ commission transparency rules. A smart business move if you ask me. As to where, unfortunately now, existing home sellers have their hands tied due to the DOJ. Unfair if you ask me, but hey, it's the way things are now. Also, with the price drops existing homeowners are taking due to the current market conditions, they are generally more apt to be tougher in negotiation for concessions or even further price negotiations. Hence the overall rise in expires that we have seen. This is also where an experienced agent like myself comes into play, knowing the pain points of the seller in order to obtain wins for my buyers. So thinking of working directly with the seller to bypass all of this? It's a thought, but again, remember, this is what real estate agents do. Represent you to win. Saving money on a buyer's agent commission in lieu of professional representation can have its serious consequences when it comes to purchase price, concessions, repairs, appraisal negotiations, and much more. Call me today to find out more. Remember that the seller wants what's best for the seller. Even dual representation by an agent, where they represent both the buyer and the seller, has its limitations by playing a neutral role between the parties. Having sole representation in your corner, in my eyes, is the best way to win. In summary, expect home prices to come down a bit more, but also anticipate mortgage interest rates to stay about the same. At this point, I'd say anticipate a more mild Q4 to Q1 of 2025 as the mortgage interest rates kind of limit the buyer's market, but also anticipate inventory to lower as a part of the seasonal swings for both builders and existing home sellers. If you are looking to make a move within or are looking to relocate from out of state, please feel free to reach out to me. I'm happy to help. So if you want to begin your home search today and search in more real time than websites like Zillow, Realtor.com, and Trulia, please visit www.mpre.homes and sign up for your personalized home search today. Also, download your free relocation guide. This can be found in the link via the description below, and I look forward to hearing from you. Sellers, it's your turn. While the last several months have not been the most advantageous for you, it looks like the RE markets here in the Treasure Valley currently are leading back to more disappointment. And why? Because mortgage interest rates went high again, and the buyer's demand is diminishing. As we lead in a slow season with high mortgage interest rates, we can expect buyers' demand to continue to soften, unless mortgage interest rates come back down and soon, which I'm not really anticipating. This will take the markets to grow comfortable with the unemployment numbers, and this could take a bit of time. The good news is we did get new leadership in the White House and control of the Senate. Hopefully the House too. We shall see in the House. However, we have to wait until January for the change in leadership. If the House were to be obtained too, though, economic policies in the U.S. could change and quicker than we think. Although unlikely for a rapid change, the change in leadership is good news for the U.S. economy and much needed help for the Fed. It could also help stave off a possible recession or lighten the blow of one, should it arise. Regardless of the election results, the Fed also may actually come in for a soft landing. This is all good news when it comes to your property values. If a recession were to come, will it be like a 2008? Absolutely not. Inventory levels are nowhere near '08 levels, as are delinquency rates to mortgages or new foreclosure filings. So if you're worried that your property is going to bomb like it did in '08, I can almost assure you that it won't. This would take an astronomical rise in unemployment to do that. But there is one thing to keep your eye on that could bomb employment numbers, and that is the stock market. The PE ratios of all three major indexes are elevated, signaling a needed correction. If companies were to lose a lot of money in the stock market, they would take it out on employment. As long as the unemployment doesn't get out of control due to the Fed's monetary policies and the stock market doesn't take a huge correction or crash, which it could, buyers will come eventually out of the woodworks as mortgage interest rates lower. This is good news for you. Also, we should still expect inventory to come down per seasonal trends, meaning less competition. As long as the gap narrows between supply and demand, we should also see a stop to your equity bleeding. If you want to maximize the value you can get from your home, selling now as compared to later seems to be the right move amidst all the lingering uncertainty, and a move that is evident by the current inventory levels. So if you agree with me and would like to know what your home may be worth in today's market, please visit my website, click on the Home Evaluation tab in the upper right-hand corner, and obtain it. You most likely will hear from me, but again, I pride myself on being a non-pressure real estate agent. If at all, I'd simply like to introduce myself in the phone call and let you know how I can be of service when you're ready. I can also set you up with monthly market reports, keeping you in tune with what's happening in your local area. And if you're ready and would like to know how we can sell your home in the quickest time possible and for the most money in today's market, please feel free to reach out to me. I'd love to set up a 30-minute appointment with you to where we can go ahead and discuss these best strategies and get you to your next destination. I look forward to hearing from you. Investors, it's your turn. And I'm sure the first thing that comes to mind again is uncertainty. And you'd be right. There is uncertainty still. Now, even as Trump is returning to the White House. What should we expect from this change in leadership? Consumer confidence to return. But until he gets into office, we are still under the leadership of the current administration, and who knows what could happen from here. But the other big question is what really is happening with unemployment in the U.S.? Has the Fed held on too long? And what about the stock market's PE ratios? All valid questions. But again, what happened not so long ago? A quick stock market crash, which has since recovered. This showed cracks in the U.S. economy. And what this did was telegraph to the Fed and the next administration problems that need to be addressed. In response, the Fed has already lowered the federal funds rate twice, and per predictions should for the rest of the year and even leading into 2025. Also, with Trump returning to the White House, American independence should return, as well as manufacturing jobs to the U.S., etc. While relief may not be immediate, it will come, and this should help stave off any large impact caused by any recession. Reverting back to the PE ratios, though, there is no question that the stock market is also overvalued. However, will there be a large stock market crash, or could a correction occur? Now that unrealized capital gains and a rise in the capital gains tax should be dead in the water due to a Trump return to the White House, this is good news for the stock market. But the fact still remains that the stock market is overvalued. We'll just have to wait and see how it reacts. Talk to your financial advisor today and place yourself in the best positions possible. And has the stock market survived a correction before? They have. It happened in 1987, 1998, 2000, 2020, and believe it or not, even in 08. Some recoveries prolonged more than the others. Now, while I can't predict the results of a possible upcoming correction of the stock market or its longevity, or even if one will hit, real estate is always a great investment during these cycles. But how? It's because real estate provides a tangible asset with intrinsic value, offering stability compared to the volatility of stocks. Owning investment properties can also generate a steady rental income, providing financial stability and diversification away from the stock market. But historically, real estate appreciates over the long term and can act as a hedge against inflation. Investors can also leverage real estate to enhance returns, benefit from tax reductions, and take advantage of constant housing demand. Additionally, real estate has offered a lower correlation with stock market performance, which can help mitigate overall investment risk. But the greatest advantage is that people always need housing, even under recessionary times. The only drawback would be is if unemployment reaches astronomical levels, which I really do not anticipate, and I mean to the point where Americans couldn't even afford a rental. If unemployment were to do so, however, this would open the door to institutional investors, much like it did in 2009. But don't bank on that. There are little to no subprime mortgages in circulation, and American homeowners have equity. There are arms out there, but not at the level or amount that we saw in 07. Even if either situation created havoc, institutional investors would give you a run for your money because they have more of it, unfortunately, to the tune of $22 trillion. But looking at today, currently, the mentioned real estate advantages apply. And in a market that's seeing almost 5.49% growth in equity since the beginning of 2024 in Ada, 10.53% since 2023, and 3.77% in Canyon, 4.87 since 2023, real estate could be a good place to park your money to mitigate the risk of a possible stock market correction, especially if you're in it for the long term and can make residual income. Historically, even in recessionary times, real estate increases in value. So if you'd like to know more about the capitalization rates you can obtain on a property here in the Treasure Valley, please feel free to reach out to me today. More than happy to discuss a potential investment property with you. All right, and renters, lastly, it's your turn. And as I always say during every single Mikey's Monthly Market Updates, you are paying a 100% mortgage interest rate. And why is that? It's because your landlord is collecting the equity. Now, I know mortgage interest rates went back to being high, but I would anticipate them, especially by mid of next year and with the change in leadership, to be able to come back down. And the Fed is constantly cutting the federal funds rate, which has a ripple effect to the mortgage interest rates. And as long as they continue to do so and the markets don't get so panicked about employment numbers, we should expect to see the mortgage interest rates come back down. But if you're looking to go ahead and set the foundation for a potential purchase in the future, feel free to reach out to me. I've got great loan officers all around the Treasure Valley that can start speaking with you today, completely free of charge, and be able to put you on the path towards home ownership. Also, please revert back to the buyer section to go ahead and see the best strategies to do so in today's market. And if you have any further questions or are looking to begin that journey, please feel free to reach out to me today. And as always, everybody, thank you very much for taking the time out of your day to watch these usually incredibly lengthy videos. But of course, if you have any further questions, please feel free to reach out to me via call, shoot me a text, send me an email. Happy to answer any questions that you do have. And if you're looking to stay in tune with this information right here on the Mikey's Monthly Market Updates, please click the subscribe button below, hit the notification bell so that you're constantly in tune with all the information that I do come up with. Again, if you are looking to make a move from out of state right here to the Treasure Valley, greater Boise, Idaho area, please click in the description below, download your free relocation guide, so that way you're in the know before you decide to make the move. And again, I look forward to the day that we speak. But before you go, please feel free to share this information with anybody that you might know. And if you really like this information too, please give me a thumbs up. It helps out the YouTube algorithm. And again, I look forward to the day that we speak. So God bless, and I look forward to the day that I call you my neighbor.